All right. Stefan, thank you for joining us on the Pulse today. We're really excited about having you here.
Thanks, John. Appreciate the invitation.
All right. Can you first just start out by explaining a little bit about what AM Best does?
Yeah, sure. Just to kind of follow up on Professor Hardwick's kind of doom and gloom forecast, at AM Best we're often accused of being highly pessimistic, so it's good to see that we're in good company. But for any of you that aren't familiar with AM Best, we're a specialist credit rating agency. We're an NRSRO, which means we're regulated by the SEC, and we're not that dissimilar from a business model standpoint from our peer global credit rating agencies, other than the fact that we are single sector, right? So we solely focus on the insurance industry. We eat, sleep, breathe insurance 24 hours a day, and that's really who we are. Our main products at AM Best, of course, are insurance financial strength ratings, issuer credit ratings, and ratings on debt issued by insurance organizations. We provide financial data and market insights, and we have quite a number of briefings, special reports on a number of markets in the United States and internationally, as well as AM Best TV.
All right, fantastic. So I believe you don't rate all insurers in the U.S., correct?
That is correct. We aspire to rate them all, but we currently do not. We have quite extensive coverage in the United States. We probably have ratings on 99% of the premium volume in the country, and that's across P&C, life and annuity, as well as health insurers.
Right.
But I think an AM Best rating is optional. So some companies choose to rely on other aspects of their financial strength or their profile to support their business and growth. But we do have ratings outside of the United States. We're active in about 100 countries, and we use a kind of a hub business model where we have offices in Europe, the Middle East, Asia, and Latin America. And we do see a fair amount of growth even in the mature markets in the United States and Europe. New cos, whether it's primary or reinsurers, tend to come to us to kind of help kind of show the market that they're legitimate, well-capitalized, well-run organizations. But probably the most growth that we would expect to see over the next 5 to 10 years would be in developing markets, whether that be Eastern Europe, Asia Pacific, or Latin America.
Oh, okay, excellent. So, when I think about companies and think about their capital positions, catastrophe has to factor into that. And kind of the elephant in the room is Ian and the Florida marketplace. So, obviously, the Florida marketplace, it's been tough. It's been challenging. And as we just heard from Bob Hartwig talking about the trial lawyers, and Florida has been a hot spot for that for years and years and years. So that's part of the problem there. And it has been a tough market for quite some time. There were companies that were going under before Ian even came to fruition. Now, since Ian has struck, what's it look like in Florida right now for insurers who are active there?
Yeah, so kind of going back to my comment about not rating every company in the market, AM Best does have fairly good coverage of the insurance subsidiaries of the national carriers that are domiciled in Florida. A lot of the commercial lines carriers and even the personal lines subsidiaries of the big national players. We follow those companies and the challenges that they face in the state of Florida. But a lot of the Florida specialist companies, they are sometimes called takeout companies, taking policies out of the state, insurer of last resort citizens. Those organizations generally are not rated by AM Best. Very few of them are. And it's not because we don't rate those companies or we don't rate new codes. We do, in fact. But our methodology would produce a very low rating. And the way it works with credit ratings is if an organization receives a result from AM Best that they don't like. They don't have to publish it, and it never sees the light of day. So it is a market that we follow very closely, but we don't have the same extensive rating coverage. And Professor Hartwig, I think, teed it up perfectly. The assignment of benefits issue, rampant fraud, the incredible amount of litigation. And just to emphasize a point that Professor Hartwig made, Florida accounts for 8% of the claims in the United States, but 79% of the claims that are litigated in the United States, which is really insane, right? That is truly crazy. And I was in Florida last week talking to a member of the governor's team, and you may know that they're calling for another referendum. They have a plan. The state is in a very strong financial position, so there could be some discussions around a more permanent kind of reinsurance backstop that's funded by the state, but also very much tackling the AOB issues and just the ability of some unscrupulous contractors to really kind of milk the insurance companies. Then comes along Hurricane Ian, which in this environment, in the inflationary environment where we're seeing demand surge aspects of rapidly rising costs around building materials, you've got a labor shortage, you've got a shortage of adjusters who really are needed to kind of get through those claims. And then very importantly, you have the interest by the reinsurance segment to continue to operate in that market. This is something we've been talking about well before Hurricane Ian. The reinsurers have really pulled back. They're assessing the capacity that they're providing for property catastrophe, and very much looking at Florida and looking where they can take very meaningful actions to improve their performance in that line of business. So things around kind of working layer covers, so kind of covers lower in the tower, are going away, as that's where a lot of the losses came from, removing aggregate treaties, and really kind of focusing on other aspects of their business versus property cat for a concentrated Florida specialist with very limited financial flexibility. Key to their business model in terms of managing their balance sheet, managing their volatility in terms of operating performance has been that reinsurance protection. It's going to be extremely difficult, I think, in 2023 to support that business model after Hurricane Ian.
Yeah, certainly. So, and as Bob Hartwig mentioned, Ian hit at a time when the U.S. insurance market was already facing the effects of other macro issues. And what's your take on really what are the big challenges that insurers are facing today?
Yeah, so looking more broadly, the investment market volatility has certainly been a challenge for some organizations. You've got a period of interest rate rises, which in and of itself, over time, can be a very good thing for the insurance market, finally getting a little bit of that investment income earning through. But rapidly rising interest rates hurts the valuations of fixed income portfolios, right? So on a statutory accounting basis, the fixed income, the bonds are classified as held to maturity, so you don't have that unrealized working their way through the statutory filings. But on a GAAP or an IFRS basis, we see a substantial decline in capital and surplus from those unrealized losses on the bonds. Couple that with not a very pretty picture on the equity side, and many of our clients are seeing a meaningful deterioration in their risk-adjusted capital. So I would say that we really try at AM Best not to take a knee-jerk reaction when we see some of these macro trends come through. Professor Hardwick made the point that the insurance industry is very resilient, and we agree with that wholeheartedly. From a capitalization standpoint, the industry is coming from a position of strength, very strong capital and surplus. You have a decrease based on what's happening in the financial markets, but really what it comes down to for our analysis is the liquidity need. right? So what is the liquidity need that these insurance groups might face where they would have to sell the bonds that are underwater or the equities that are trading at lower valuations? And so in our view of risk-adjusted capitalization, we will kind of add back those unrealized losses, and then we'll shock the balance sheet for what we would consider a liquidity event. And that analysis, again, is really showing that the insurance organizations rated by us in the United States have a very strong ability to kind of ride this volatile investment market out. So that's the one piece on the financial market side. The other piece around social inflation is critically important for the insurance industry. The litigation finance is real. The plaintiff's bar is absolutely in a position of strength, and they're looking for weaknesses within the insurance industry, unfortunately. They're looking for the insurance organizations that maybe are more likely to settle, maybe are less likely to take that trial attorney all the way through the system and appeal, et cetera, et cetera. But it's a very real aspect of the loss experience of the long-tail casualty writers in the United States, and it's really going to be a challenge to try to confront that.
Absolutely, absolutely. Any other headwinds we should be looking for?
Lots of them, John, plenty. Kind of back to pessimistic AM.
I was going to say, not that this is gloom and doom or anything, but
not to be too negative, but let's talk about some more negative stuff. So what do you have? You have climate change, right? And you have what we absolutely see are a increase in the frequency and severity of natural catastrophe activity, whether it's primary perils, hurricanes certainly, as we just saw down in Florida with Ian, but also what they call secondary perils, whether it's winter storms, tornado, hail, straight line winds, wildfires out west. I think at some point we're going to do away with the term secondary perils because, as we know, they can produce the size industry losses that rival the primary perils in many cases. And the modeling companies, I would say, are challenged to keep up with these changing trends, a little bit like the actuarial models relying on historical experience. So, I think for the insurance community, for property writers, really trying to understand what these climate-related risk aspects mean for their book of business, I think will really be a challenge. Couple that with an inflationary environment where TIVs are rising and reinsurance capacity, ILS capacity is shrinking. So, a real challenge there. The other thing that comes to mind would be cyber, of course. I think as financial services companies that have a lot of data, we're of course at risk to a cyber attack. I think probably everybody in this room can think about how much their organization has invested in cyber resilience, and it's because these threats are real. And then so you have that aspect, but you also have the aspect of underwriting cyber exposures, right? We have more and more kind of new codes coming to us interested in an AM Best rating, and they're cyber specialists. And so, how do you underwrite and price for cyber? How do you manage aggregations of risk for cyber where the PMLs aren't limited to a geographic footprint like you would have a Nat Cat type peril? So, two other challenges for the industry, certainly.
Yeah, and you mentioned the frequency and severity, and certainly one of the things on the severity side that we've seen over the last few years anyway is issues with supply chain, so slowdown. And Bob Hartwig mentioned that also, the slowdown in repair time and things like that. And is that something that you think is going to be fairly short-lived at this point? Are we getting close to an end on that, or is that something that's going to be with us for a long time to come?
Yeah, I've heard kind of both sides of that argument in terms of whether it could be coming to an end. Particularly personal auto is the kind of poster child for just these shortages in material shortages in chips and parts, and is part of why loss costs for that sector of the industry is struggling so much to get back to profitability. But I have heard that these are going to be headwinds that are going to be with us for possibly the next year or two before those manufacturers are really back online and at full capacity.
Terrific. Not terrific, but thank you for that. All right. So another thing that we've seen going on in the marketplace for some time now, and seems to be, if anything, picking up a little bit, is merger and acquisition activity. And is that a result of economic conditions, or is it something else driving that? Something maybe more positive, opportunity, as opposed to that?
Yeah, so I think if I would maybe start my comments on the distribution side of the insurance business. As we know, for years and years, whether it's agents, MGAs, MGUs, brokers, there's been massive amount of consolidation on that front. The valuations are at all-time highs. So, in many cases, you have a sole proprietor that doesn't have, a member of the family that wants to take over the business. So they're looking for a way out. Private equity investors, an enormous amount, trillions of dollars of PE money waiting on the sidelines, looking for investment opportunities. That kind of non-risk-bearing aspect of the insurance industry is very appealing to PE investors, as is annuity sales and closed block acquisitions on the life side. But so you have that on the distribution side. For insurance companies, very few insurance companies want to lose their independence. Right, so generally, insurance organizations don't sell outright unless they're in a position of weakness and feel the need to do so. I would say the exception to that is for more diversified insurance groups. We do see pieces of the insurance group going up for sale, maybe shedding non-core businesses in order to kind of free up some capital and kind of go after organic growth where they see opportunities in their primary business line. So I think it's very hard to predict, when the next wave of M&A is going to take place on the company side, but it's always there for those factors. Related to that, we do see quite a lot of interest in ceding business to the runoff specialists, right? The NSTARs, the R&Qs, through LPTs and other sorts of reserve transfers. Again, another way of freeing up capital to write business going forward and maybe protecting the balance sheet against some of these inflationary pressures on existing reserves.
All right, so what does AM Best really look for when you're looking at these mergers or acquisitions occurring? What do you look for in the new entity?
Yeah. So it's an interesting time for us from a ratings perspective. A lot of acquirers sometimes think by default they will acquire the AM Best rating of the target, and that's really not necessarily the case, right? For the existing organization, we have the track record. We know how profitable and healthy the business is that is being acquired, but we'll have a lot of questions for the new owner around their expectations for that organization. How are they going to capitalize that organization? What kind of financial leverage are they going to introduce? What's their track record of owning insurance companies? Are they going to make changes to senior management where maybe some of the people that really had the relationships and were driving a profitable book of business, is it possible that they're going to be pushed out, and where's that new level of management coming from? So when we see a transaction, once a definitive agreement is signed, we generally put the organization under review as we discuss with the new ownership how they plan to run the company.
It seems like that would be highly complex because each one of those activities has to be undertaken, for a very specific reason, and they've got to have a good plan. And I'm sure you're just trying to learn all you can about what that plan is, how they're going to execute, and how they're going to pull those organizations together.
Absolutely.
That's interesting. I had kind of skipped over one of the things that I had wanted to touch on before, so if you don't mind, I'm going to kind of bounce back. You talked a little bit about reinsurance, but can you give us kind of I'll say a little bit deeper dive. What's going on in the reinsurance marketplace today? Obviously, there's a lot of activity going on there, with with catastrophe losses and just the general trends that you've shared with us as well. So what's that market looking like today?
Yeah, so we tend to look at the reinsurance market, not so much just the US market or the Bermuda or the Europeans. We look at kind of the global reinsurance market. It's a much more homogeneous market. It's to some degree syndicated. So these comments apply not just to the US insurers, but more of a global. We have a stable market segment outlook on the reinsurance industry, which has been in place for a couple of years. The industry has, out of necessity, really pushed hard and has been able to achieve some pretty good rate increases over the last several years. We've seen a tightening of terms and conditions. We've seen a pullback from those property cat exposed lines of business that had been producing a lot of volatility. And this was all taking place before Hurricane Ian. So, we would say that probably today the reinsurance segment is in a better position from a underwriting performance standpoint than it's been in the last 10 years. And that the pressure is really coming from investors and other stakeholders, where if you look at the performance of the reinsurance segment over the last 5 years, their ROE is kind of right around maybe the mid-single digits, and that's with 2 or 3 points of favorable reserve development boosting those ROEs. And that's really just not at the cost of capital for the reinsurance sector. So there's been a lot of momentum to try to get the rates where they need to be in order for the industry to produce a reasonable return on capital. Absolute capitalization has been very strong for the industry. Enterprise risk management, the profile of these top 25 global reinsurers who probably account for 80% of the global reinsurance premium, they're diversified, they're very sophisticated businesses. It's really just been that return that's fallen short. So I guess the last point I would make around the good news for the reinsurance segment is what's good for the reinsurers is not always necessarily good for the primary insurance companies, right? Again, back to the comment around, if you're a fairly concentrated primary insurance company with a property book of business that has exposure to weather events, et cetera, and you were reliant upon reinsurance to manage that volatility, I think that's going to be a challenge coming into next year.
Certainly. Thank you. So that kind of leads right into the next question. What would you say is the state of the overall U.S. insurance marketplace?
Right. So looking at the commercial lines market, we also have a stable outlook on the commercial U.S. P&C market segment for commercial lines, and that's driven by many of the key lines of business performing extremely well. Workers' compensation, despite some rate pressures, has produced incredible results pre and during, and if we can call today post-COVID. It is really remarkable. Frequency remains down, severity is under control, and the reserve releases keep coming through. So the performance of workers' comp has been tremendous. Specialty and E&S also incredible results, and there's a lot of probably 15 new specialist NewCo companies launched over the last couple of years to try to access this business, but the performance still remains extremely strong. Not that there aren't any headwinds for commercial lines. Back to that social inflation, litigation, finance, nuclear verdicts, still trouble for commercial auto, medical malpractice, and GL are still kind of trying to work their way out of a bit more of a hole from a rate standpoint, rate adequacy standpoint, although those lines are leading the charge in terms of the amount of rate that they're able to get year over year.
All right. And what about personal lines in particular?
Yeah, so for personal lines, we had a stable outlook on personal lines for many, many years. A lot of the companies that we follow have really come a long way with, technology adoption, innovation, predictive analytics and risk segmentation. Personal lines carriers have really led the way there, but many of them have kind of fallen behind some of these macroeconomic factors that we were just talking about. The loss cost inflation has really gone through the roof, and some of the insurance groups that we follow have been proactive, have been able to take rate increases. Others are behind the curve, and the performance for personal lines for our composite was maybe 106 combined ratio, which for a relatively short tail line of business is not very good. So we have a negative outlook on the segment, really driven by the headwinds facing auto. Home is in a better position, but again, back to those climate-related risks,
right.
certainly, and the availability of reinsurance will continue to challenge homeowners, writers. And then the last point that's, I think, very, very applicable to personal lines companies is the ability to get the rate that they need, right?
Absolutely.
So that they may know what the actuarially justified rate is, but the ability to try to get that through in one shot in their state could be a real challenge.
Yeah, absolutely. So is there anything on the horizon that AM Best believes could have an impact on the U.S. market, other than what we've already discussed, I guess I'll say? You know, just thinking of, we got midterm elections coming up, we've got everything going on with, well, we talked a little bit about inflation, but the adjustments to loan rates and so on.
Yeah, I don't know if it's right on topic, but I would be remiss by not mentioning the MGA market and the growing importance of MGAs, MGUs in terms of access to business for insurers and reinsurers. Before we got started this morning, I was speaking to a couple people who are active in that market, providing various services, and what we're seeing in the P&C market in the U.S. and in other markets as well is just kind of the growing importance of MGAs as a source of distribution, as an access to programs and specialty lines of business. And as a result, after a lot of kind of market studies and discussions with industry participants, you know, at AM Best, we have a new initiative which was launched earlier this year, which is what we call the performance assessment for DUAEs, which is Delegated Underwriting Authority Enterprises. It's quite a mouthful, but it's kind of code for MGAs, MGUs. Yeah. And I think for us, that's really a recognition of the growing role of these organizations in the insurance value chain. So we have just recently launched this product. Again, it's not a credit rating, it's more of a service evaluation where we're looking at the quality of the programs, financial health of the MGA, and you know their ability to take on, say, underwriting authority or claims handling authority for the insurance or reinsurance organization. We just recently added AmWins to the group of MGAs whom we are providing these performance assessments for. So you know, I think that's an interesting area of the market to watch. As growth becomes more challenging, organic growth, having those relationships with the distribution partners can really be a steady, dependable source of good business to come through.
Absolutely, absolutely. So we've got a little bit of time here. We'll see if we've got some questions out here.
Sure.
All right, any questions from the audience? I don't know.
Covered a lot of ground.
We have one from online. How can insurers reserve adequately for nuclear reserves?
Okay. So that is a really good question, and it's a real challenge for the market, right? So if you've got the specter of nuclear verdicts, you know, how does an insurance organization set an appropriate reserve for that? And yeah, so you know, based on the size and scale and diversification of the insurance organization, it's important, if you want to maintain a level of reserve adequacy, to understand the nature of the case reserves and use technology, innovation, and data analytics to identify those that are most likely to be targeted by the trial bar and get ahead of those claims as best you can and try to close them out as fast as possible and prepare for the potential for a fight in those cases, right? And really identify where as an insurance organization you can kind of push back and maintain, you know, the contractual terms that are going to derive that ultimate claims resolution. So you have that aspect of really trying to data mine your book of business, identify those troublesome claims early, but also, as Professor Hartwig said, as an industry, really trying to work together to combat that, perhaps more at the political level, and try to kind of chip away at the strength that the trial bar has across the different jurisdictions.
Yeah, so it feels like part of that is, it's just that, right? So it's finding the ones that are most likely to go nuclear, for one, and managing those as effectively as possible, continue to try to drive for reform. Is part of it also at this point to just, do all of that, but just understand it's going to happen, and I don't want to say pad reserves, but factor that in, because it's going to be with us for some time, even if we're highly successful in attacking it at a legislative level.
Yeah.
It's still going to take some time for it to really go away.
Yeah, absolutely, John. There's no quick solution to this problem, but I think it's important for the insurance companies to face the reality that they are going to be exposed to these claims. And most of the insurance companies that we follow, they work very hard to avoid reserve deficiencies, right? Because you're just kind of pretending that your balance sheet is stronger than it is. You're pretending that your underwriting performance is stronger than it is. So really, the impetus to get the reserves right, even if there's some bad news in there, I think is going to lead to a healthier organization, even though it's painful to do so.
So that's all the time we've got for today. Stefan, thank you very much. Really enjoyed having you here, and you provided us with some terrific insight. So thank you again. Thank you very much.
Thanks, John.
All right. With that, I'd like to remind you that we'll be back at the top of the hour for another unique session looking at the use of blockchain in insurance, including a regulatory report with John Godfrey, the North Dakota Insurance Commissioner, and special discussion with our own Joan Zurkovich and her guest Tram Vo, CEO and founder of Moby. Stay tuned.